Okay, so today we're going to be going over risk management. And risk management, essentially in day trading, it's the only thing that you can control, right? So that is why it's the only edge that you have over the market, because it's the only bit of control that you can gain over the market. And I just want to go over what we learned so far so we can kind of get an understanding of where we're heading. So we understand that the market is a continuous auction between buyers and sellers. We've discussed that in episode 1. The market is either ranging, going sideways, meaning it's balanced, or it's expanding, going upwards very aggressively or down very aggressively. And we know that the market does spend majority of the time in a balanced environment. An imbalanced market means market is trying to find fair value. So the market is still trying to decide on a fair agreement in price. And a balanced market means participants are generally in agreement over price, right? We understand that candlesticks allow us to visualize the auction for a specified period. For example, if we're choosing a 1 minute candlestick, we can see 1 minute worth of auction. We understand that retail traders, hedge funds, central banks, brokers, and market makers make up the majority of the market, right? These are the major participants, and we do have algorithms and things like that as well. We understand that volume represents the amount of shares transacted over a specified period. It helps us gauge how strong or weak a particular move is, right? And a market order is an aggressive order executed at the first available price. A limit order is a passive order that waits for price to reach desired level before entering the market. We understand that in reality, trading is extremely difficult to succeed at. This is because majority of traders chase perfection in a random market. Majority are misled by influencers into believing it's a get rich quick scheme, right? So when you have a false perception of something, once the reality doesn't actually realize, it doesn't hit, you start to kind of act irregular, and it becomes extremely harder to become profitable, right? And I do want to mention that a lot of people, they kind of dig themselves a hole because they get into trading thinking they can get rich quickly. They spend all their money at the start whilst they're still trying to learn, and then before you know it, they're down their entire savings. They've lost all their entire savings, and that's kind of the reason why the statistics are very skewed, because it does say 90% fail, but that's because people quit before they even understand how to become profitable. So that's kind of why we're trying to make sure you have the correct mindset, you have the correct process in place, and then once you're approaching the market from the correct mindset and the correct process, we can then go on to the technicals, and then you can learn the technicals over time. If you do have the correct process and the correct mindset in place, the technicals are only a matter of time, right? It might take you a year, or 2 years, or 3 years to master it, but we need to make sure that the correct backbone is in place, because if you can become a master at technical analysis, but if you are still blowing up the account because you're not able to control your emotions, because your process does not protect you from yourself, then there's no point learning the technicals, right? Human nature also makes it very hard for us to become profitable long term. So we discussed loss aversion, meaning losses hurt us a lot more than wins do. That's just how life works. When you take a loss, it hurts a lot more than the feeling of taking a win. It hurts twice as much, actually. And we discussed what tilt is. And it's important to remember that we cannot control the market. We will never be able to control the market because we don't have enough funds to control the market. We don't have enough power in the news and the media to control the market, right? There are some people that do have enough power and influence to control the market, but that's not us. The only thing that we do have control over is our participation in the market, meaning we cannot control the outcome, but we can control our risk, when to get involved, when to walk away, and we can also focus on having a process-oriented approach over an outcome-oriented approach. So this means following our process, following our plan, regardless of how we feel or regardless of the outcome. So what is risk management? Risk management is a set of rules that you give yourself before entering a trade. This is to ensure that no single loss or no string of losses can seriously damage your account or your ability to keep trading. It is the only bit of control that we have over the market. It is the only true tool that can give us a predetermined outcome. It's the only thing that we can control with an actual specified outcome, right? So um, basically, it is there to ensure that no single loss that we take can seriously damage our account, right? It's kind of like when you drive your car, you don't actually expect to crash your car, but you still wear your seatbelt every single time you drive it, right? That's because that's what risk management is, right? That way, in case you do crash your car, your seatbelt is there to protect you. Um, and I do want to mention that risk management is the most important part of trading, but it is often overlooked because no one goes into the market with the expectation of losing. Remember how we discussed that people have a misconception of trading? Where is it? Because of the influences, right? So no one actually goes there with the expectation of having to manage their risk, of the expectation of having to take losses, right? Okay, so risk management essentially is about controlling the things that we can control and not worrying about things we can't control, right? The things you can't control is once you enter the trade, you do not know where it's going to go after you entered. You cannot control macro and news events, right? So Donald Trump can just tweet something and then the market can go upside down because of a tweet that he made, for example. You cannot control other market participants and their actions in the market. You cannot control the randomness of the market, and you also can't control how algorithms and institutions react to the market, right? What we can control in the market, so these are things that we can control, and that's why we must focus on these things because obviously we do want a sense of control in the market. Whether you take a trade at all, whether your stop loss is placed, so that's very important to place a stop loss, how much you're risking per trade, your risk to reward target, we'll go into that later on, when to stop trading for the day. So for me, I have a max loss on each account where if I hit that max loss, I stop trading for the day. And the reason being is because that max loss generally means that I am not reading the market correctly, right? Or there's something wrong. So that allows me to walk away and come back and reset. And what you can control is how you react to losses, right? If you take 2, 3 losses, are you entering the fourth trade because you really want to make your money back? Or are you entering because there's an actual trade at hand? Okay, so what is a stop loss? All right, so a stop loss is basically the backbone of risk management. It's your predefined exit point when the trade goes against you. You have to use a stop loss in order to prevent small losses becoming much larger. It allows you to remove emotion from the exit decision, right? It protects your account from a single bad trade, right? Remember how we want to be able to take hundreds of trades, not just one trade. And it forces you to define the risk before entering. And I'll get into more details on how to place your stop loss because a lot of people actually don't understand how to place your stop loss, right? Your stop loss essentially it has to be where you are invalidated, where your trade idea is wrong. That is where your stop loss goes. It does have to be based on market structure and not just a random price point. It cannot be too tight because you don't want to get stopped out and still be correct on the idea. And obviously cannot be too wide because you don't want to risk too much money, right? So the common mistakes people do make is they move their stop loss further away to avoid a loss. So as the market starts going down against you, you move your stop loss because you don't want to take the loss. Remember, we discussed loss aversion. You don't want to feel that feeling of losing, so you move your stop loss. And this is you breaking your rules, right? And this is how a $100 loss can become a $300 loss. And what this does is this ruins your risk to reward in the long run, but we will discuss that also later on. So you must predefine your stop and never widen it. And one thing I want to stress, I will have an episode on stop losses and how to actually place your stop loss, but I want to stress that you must remember, if you take one thing away from this, is you must remember that your stop loss has to be based on an invalidation level. It has to be based on a level or a price point where you are wrong on the trade idea. So you have a trade idea, your stop loss must be where you're wrong, right? It's not a random price point in the chart. It must be at an area where you're wrong. So I want to show you an example on the chart quickly. So let's just say I have this daily level over here. We'll get into these levels and how to find them later on. If I want to go short, what I'm doing is I'm trying to find out where I'm wrong. So now I know that if we come back up here and we take this high and we reclaim the daily, then I am wrong. I want to be out. So if I'm entering a trade here, for example, I want to make sure my stop loss is above this high and it's not just in a random price point somewhere here because I don't want to lose too much or because of any other factor, right? So one thing I want to stress is the amount of contracts that we enter is determined by where our stop loss is and not the other way around. I see a lot of people enter, let's say they're risking $2,000 and they automatically put their stop loss here because that's where $2,000 is, right? That's where a $2,000 loss will be. Instead of sizing down, instead of trading less contracts so they can have a wider stop loss, they trade the same amount of contracts and they have a tight stop loss, right? But now I know that my invalidation, where I'm wrong on this trade idea, will be above this high. That means my stop loss has to be above this high because I want to get out when I'm wrong. I don't want to get out randomly just because it went against me a little bit. I want to get out when I'm invalidated. That's very, very important. Your stop loss has to be based on an invalidation level. All right. Okay. So your stop loss must be placed at an area where if market does hit that level, you're probably wrong on your trade idea. Okay. If market goes up here, I am probably wrong. That's why my stop loss has to go up here. So now I'll have to calculate my position sizing if I want to risk 2,000 per trade, for example, and figure out how many contracts I can enter. Okay, now we got risk to reward. That's another element of risk management. Essentially, for every dollar you risk, how much do you aim to make, right? So your risk to reward tells you how much potential profit you are targeting relative to the amount you're willing to lose on a trade, right? So the first R is risk, the second R is reward. So the potential profit is the reward. How much you're willing to lose is the risk, right? For example, a 1-to-1 or 1-to-2 risk to reward, that's very good. That's generally what we aim for because it means you're risking $100, that's the 1, to make $200, that's the 2, right? This is basically a 1.05 risk to 1 to 0.5 risk to reward. It means you're trying to make $50, but you're risking $100. This is essentially not good risk management. And it'll be very hard to become profitable using this risk to reward. I do want to mention that as time goes by, you'll have more dynamic risk to reward, meaning you'll be, depending on market context, market environment, a lot of other factors, you might have a 1-to-1, you might have a 2-to-1, you might have a 3-to-1. You probably don't want to take a 0.5-to-1 ever. I probably never take that. But what I'm trying to say is once you get more advanced, your risk to reward can become more dynamic and you can kind of react to the market rather than just be robotic with your risk to reward. But key takeaway is you don't really want to be taking this side of the trade where you're risking 100 to make 50. You do always want to be at least getting a 1-to-1. Let's not overcomplicate it. We'll get into more advanced theories and advanced dynamic risk to reward and trailing your stop loss and things like that as we progress. We just want to make sure we understand what risk to reward is, we understand what a stop loss is, and why it's important to have your stop loss at an invalidation level, right? Your stop loss, I know I keep saying the same thing, but your stop loss has to be based on an area where you're invalidated because you want to be wrong. You don't want to be out and still be correct. You want to be wrong when you're out, okay? And also your trade size, the amount of contracts you're trading, has to be in relation to where your stop loss is, right? So if my stop loss is $100 away and it's a $1,000 asset, let's say it's 10% away, right? And I want to risk $50, I have to only trade half of the asset so I can have a $100 point stop loss, if that makes sense. And this is why risk management is important. So I just wanted to quickly highlight the maths of losing, right? So losing a percentage of your account always requires a larger a larger percentage gain to recover the loss, right? And most beginner traders ignore this. This is why I say people dig themselves a hole at the start. So most beginner traders will come in, they'll have $10,000 worth of savings. They'll see some guru online flashing their Lamborghini, right? They put their $10,000 in and they quickly lose it, right? Within 3 or 4 trades, they don't understand risk management. They don't understand the importance of survivability. Before you know it, they've got $1,000 left and they need to make 900% to get back just to break even, right? And that's why I want to mention while we're here, and that's why prop firms are essential, right? They allow you to reduce your upfront expenses, and they ensure you're not digging yourself a hole while you're still learning the ropes. And you can pay as little as $100 per month on average, Australian, for a prop firm account. And even though you're not expected to succeed, we wouldn't be expecting you to succeed within the first year or so, it is still better than trading demo, because we do want to kind of involve you with your emotions. We want to be able to you want to be able to feel, reflect, and react to how you're feeling. And demo accounts don't really give you that emotional like learning curve, right? It doesn't really let you experience emotions, and it doesn't really let you work on your psychology because you're trading full demo. But when you're trading prop firms, and you do have a chance to pass, you do have a chance to get a payout, so there is a bit of emotions involved. But yeah, prop firms are essential for beginner traders, because instead of spending $10,000 in the first year blowing your account, you can spend $1,000 a year. It can take you 2 to 3 years. That way, worst case scenario, you're down $3,000 for 3 years. That's not too bad, right? Okay. So I want to show you a real world example of a person that doesn't have any rules, does not manage their risk, compared to a person that does have rules, right? Let's say everyone has a $10,000 account. This person, he's only allowing himself to risk $100 per trade, which is 1% of that account, which is very minimal, right? And he stops trading after 3 losses a day. This is an example that, for me, if I take, these amount of losses, I generally stop trading, because it means I'm not reading the market correctly, right? And I want to kind of have a fresh mindset the next day. I want to have a new market to read, and obviously, yeah, just a refreshed mindset. And also, I noticed after I take 2 or 3 losses, my fourth trade is generally not going to be a good trade. It's going to be a forced trade, right? This is understanding myself, understanding my emotions, understanding my habits, and knowing when to walk away. And that's something that obviously you'll journal, you reflect, and I will teach you how to journal properly and all that. I just need to understand why it's important now. So this person takes 10 losing trades in a row. His account balance is still 9,000. He has survivability. He's still able to trade, right? This is an example of a trader that doesn't have any rules. He goes into the market with the hopefulness of receiving a certain outcome, hopefulness of making money very quickly, right? This is because they have the wrong mindset, and they're misled, right? We've already discussed this, but now we're seeing what the outcome of it is. After he loses the trade, he doubles. Oh, sorry. He doubles the size after each loss. Remember how we said people don't like losing, loss aversion. They want to feel that they made their money back. So you lose a trade, you double your size after to make your money back. He does not have a daily stop loss. So if he has a fight with his parents, if he has a fight with his girlfriend that day, and he's in the very bad mindset, if he got fired from his job, if whatever happened, he's in a bad mindset, right? And he doesn't have a daily stop loss, so he's letting himself trade while he's on tilt. And the bad thing about this is, if you're trading when you're on tilt and you don't have a daily stop loss in place, essentially you can lose your whole account in one day. That's the scary reality of trading. It's kind of the only industry that I can think of, maybe other than like a heart surgeon or something, where one bad day can lead to a catastrophic loss, right? So if you think about it, every other, even like professional footballers, they can have a bad game, right? They come back next week, they can rip it up, and they're back to normal. Like the likelihood of one bad day ruining someone's career is very low in any other industry. I know this is scary, but this is the facts, unfortunately. Whereas with day trading and maybe a few other industries that I can't even think of on the top of my head, one bad day, if you do not control yourself, if you do not have parameters in place that protect you from yourself, one bad day can unfortunately wipe out your whole account. Because you're trading on tilt, you can size up, you can use leverage, you can make many stupid decisions very, 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 very quickly. And I'm hoping this kind of scares you, because I really do need you to lock in on the process side of things before we can get into the technical. I know you just want to get into the technical, but we really need to stress this, that one bad day can, and it does, wipe out people's whole accounts if they do not have parameters in place to protect them from themselves, essentially, right? As we said, this guy went on tilt because his girlfriend cheated on him. He opened up the chart. He has 10 losing trades in a row. His account balance is now at 0 because he's doubling size after every loss. He does not have a system that protects him, and within just like that, he blew his account. Okay, that's a real life example as well. Like, obviously I don't know someone that's, but this does happen to people, right? This is normal. That is why everything we've been doing so far, it's very, very boring, but we need to make sure you understand how it works, why people lose, and from there we'll put the right systems in place to protect you from yourself, from the market randomness. And then after that, we'll get into technicals, and whilst you get into technicals, we will show you, you can start trading demo. After your trading demo, we will make sure that you're journaling correctly, you're OODA looping, essentially. I'll explain to you what that means. And whilst you're doing that, we just need to make sure that this is in place. And then whatever, if technicals take you 1 year, 2 years, 3 years, you might find that you don't like the way that I trade, because everyone trades differently and there's no right or wrong way to trade. But everyone that is profitable agrees on this, that you have to protect yourself from these certain possibilities. Everyone agrees on this. Other people trade differently to me, that's for sure. But every profitable trader does agree with me on the process and the psychology on the risk manager. Okay. That is why once we put this in place, everything else will come smoothly. No matter if it takes you a year or 2 years, it doesn't matter, because you're only going to have little expenses and you're going to give yourself the chance to be profitable. If we go into trading with this type of mindset, and I know you're very excited to trade, and it's only going to hurt you. We need to go into trading with this type of mindset, slow and steady, process oriented, and then we can improve as time goes by. Okay. And this is the general pre-trade checklist. It's just very general that I wrote up. But the template that I give you will actually cover your mindset, it'll cover your emotions, it'll cover your technicals, and it will cover your risk parameters. So the template that I'm going to go over in the next presentation, and I'll teach you how to use it, will be much more important than this. This is just a general one that you can just kind of try to memorize on top of your head, but then the template will kind of be more actionable. It'll be a lot easier to kind of proceed with it and turn it into a habit. Okay, so now we understand why the markets move, the reality of day trading, especially in the retail space, and why everyone doesn't really make it as a trader. Well, the majority of people don't. And even though it does say 90%, we don't want to scare you, because the majority of that statistic is just people that try it for 2-3 months and they don't have the right guidance, and then obviously they give up, or they blow all their money very quickly because they don't have the right principles in place, and then they blow up. Now we understand risk management and why it's important. And next I'll be showing you the template that I use, and I'll be showing you how to build an effective daily system. Well, you'll just be using the template that I have, because it's obviously I've built it over the years, and it's just the easiest way for me to make sure my mindset is in check, my emotions are in check, my risk management is in check, and also my stop loss and my stop loss and kind of like my trading day is kind of process oriented and not outcome oriented. And this is the book that I need you to read. I've already mentioned it in the initial file, but this book is very, 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 it's only like you can get it for 10-15 bucks. Best Loser Wins by Tom, what's his name? Tom Hugart, all right? He basically explains why people lose, why emotions fuck you up as a trader. He explains how he overcame emotions, how he explains his system. He explains how he meditates, and he kind of in short, he kind of envisions himself losing before he even opens the chart. And when you're doing that, in short, when you're envisioning yourself losing before you even open the chart, it means that if you do take the loss, let's say your max loss is 500 for the day, and what we want to do as day traders, we want to make sure we're not reacting in a negative way after we lose. And the best way to do that is to kind of practice that feeling before you even experience it, correct? So what he likes to do is he likes to meditate, and he likes to envision the worst possible scenarios when it comes to day trading. Example, getting stopped out and then the trade going his way. Sometimes you get wicked out and then it goes your way. Sometimes you might miss a trade. So he kind of likes to meditate and envision all the worst case scenarios that could happen. And that way, when he does take the trade, and when he does take a loss, for example, he's already practiced. He's already familiarized. I don't know how to say the word, but he's already familiar with the feeling. And when you're familiar with the feeling, you're less likely to react with a snap of a finger, right? So that's kind of why he meditates on the losses before he even opens the chart. And he kind of has that mindset, which every trader should have, that mindset of expecting to lose. You don't want to expect to win, you want to expect to lose. Because if you're expecting to lose, you're kind of prepared. You're prepared to cut your losses. You're prepared to not go on tilt. You're prepared not to get too emotional. So long story short, bro, I do recommend this book. I've read hundreds of books for trading, but this is probably the one book that just like changed everything for me. And it made me really understand that like if I wanna win in the long term, I have to lose properly. That's why it's called The Best Loser Wins, because he understands and he explains that people that are profitable, they're just very good at losing. It's not because they're amazing at technical analysis, it's because we're very, 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 very good at losing. You have to be good at losing in order to win. Right?